Most people have been watching the silver price every single day. Maybe you check it first thing in the morning, then again before the market closes. The headlines focus on whether silver moved up or down, but that's only part of the story. The real development has been happening quietly behind the scenes, inside the vaults where physical silver is actually stored. And what is unfolding there paints a completely different picture from the one flashing across your trading screen. Welcome back to Ag John Silver Update. Before we dive in, let me make one thing clear. I'm not here to promise that silver is about to hit $100 overnight or make dramatic predictions about where prices will be next month. The truth is, nobody can forecast the market with certainty. Anyone claiming they know exactly what's coming is usually trying to sell you something. My goal is much simpler. We're going to look at the actual numbers, the official warehouse reports, and the physical inventory data that many investors never bother to examine. Right now, those reports are revealing something that deserves serious attention. If you already own silver, are thinking about buying it, or simply want to understand where this market could be heading, I encourage you to stay with me because this isn't a quick story. There are several important pieces that fit together, and by the time we're finished, I believe you'll see today's silver market from a completely different perspective. Let's begin with the foundation because this is where so much confusion starts. Even experienced investors sometimes overlook these details, yet they are essential for understanding what's really happening. Most people know that COMEX is where silver futures contracts are traded in the United States. It's part of the CME group and serves as the country's primary futures exchange for precious metals. Every standard silver futures contract represents 5,000 troy ounces of silver. But here's the part that rarely gets explained. COMEX isn't just a marketplace where traders buy and sell paper contracts. Behind the scenes, it's connected to a network of approved storage facilities located around the New York area. These vaults, operated by companies such as Brinks, Loomis, HSBC, JP Morgan, Malka Amit, and several others, contain real physical silver bars weighing roughly 1,000 ounces each. These aren't numbers on a computer screen. They're actual bars stacked securely inside professional vaults, and every business day COMEX publishes inventory reports showing exactly how much silver is being stored in each location. Those reports divide the metal into two separate categories, and understanding the difference between them is one of the most important concepts in the entire silver market. The first category is called registered silver. This silver has an official warrant attached to it, meaning it's available to satisfy futures contracts if someone chooses to take physical delivery. In simple terms, this is the silver that's officially on the market and ready to change hands. The second category is known as eligible silver. It meets all COMEX purity and weight requirements and sits inside the same approved vaults, but it isn't currently available for delivery. The owners are simply storing it there. They haven't authorized it to be used for future settlements, and nobody can force them to release it. Think of registered silver as merchandise sitting on a store shelf with a price tag attached. Eligible silver is more like inventory locked away in a private warehouse. The owner might decide to sell it later, or they may decide to keep holding it indefinitely. That distinction may sound minor, but as you'll soon discover, it changes everything about how we should interpret today's silver market. What makes this distinction so important is that many headlines simply report the total amount of silver inside COMEX vaults. They combine registered and eligible silver into one large figure, making it appear as though there's an enormous supply available. On the surface, everything seems perfectly healthy. But that's not how the system actually works. Only registered silver can be delivered to someone holding a futures contract. Eligible silver belongs to private owners, and unless they voluntarily decide to convert it into registered inventory, it remains unavailable. That's why looking only at the combined total can create a false sense of security. Now here's where things become far more interesting. Throughout 2024 and into the early part of 2025, COMEX experienced a massive wave of incoming silver. One of the biggest reasons was growing concern over possible trade disruptions and tariffs. Banks, dealers, and large institutions shifted huge amounts of metal from London into New York to reduce risk and position themselves for potential market changes. As a result, registered silver inventories climbed dramatically, eventually approaching the 200 million ounce mark. At the time, many believed the system was becoming stronger than ever. But that wasn't the end of the story. After reaching those elevated levels, something changed. Instead of continuing higher, registered inventories began falling week after week. What first looked like a temporary decline gradually turned into one of the largest sustained drawdowns seen in years. Recent warehouse reports show that registered silver has fallen dramatically from those highs, with estimates generally placing available deliverable inventories somewhere between roughly 85 and just over 100 million ounces, depending on the reporting date. Think about that for a moment. Roughly 100 million ounces disappeared from the registered category in less than a year. That's not a small adjustment. That's an extraordinary shift. And it didn't happen because of one unusual event or a single large shipment. It happened steadily, report after report, with inventories continuing to shrink over an extended period. Now, it's important to understand exactly what that means. Not every ounce physically left the vaults. A significant portion was simply moved from the registered category into the eligible category. In other words, the owners removed the delivery warrants, deciding they no longer wanted that silver available to satisfy futures contracts. In many ways, that's even more revealing. Instead of selling their metal into the market, these owners effectively stepped back and said, "We're holding on to it." That's a powerful message. They're looking at current prices, watching demand develop, and deciding that now isn't the time to let go of their silver. Of course, not all of the inventory stayed in New York. Large quantities have also been physically shipped out of COMEX vaults over recent months. Outbound movements have remained unusually strong, with silver leaving warehouses at a pace well above historical averages. We'll discuss where much of that metal appears to be heading shortly. But before we do, there's another misunderstanding that deserves attention because it shapes how many people interpret the entire silver market. Whenever mainstream financial media discusses COMEX inventories, they almost always highlight the combined total of registered and eligible silver. While technically accurate, that single number often hides what's actually happening beneath the surface. Yes, hundreds of millions of ounces may still be sitting inside approved COMEX vaults. But the critical question isn't how much silver is stored there. The real question is far simpler. How much of that silver is actually available if investors decide they want physical delivery? Once you ask that question, the picture starts looking very different, and that's where the real story begins. This is where the conversation becomes much more serious. When someone says COMEX has plenty of silver, ask them one simple question. How much of it can actually be delivered? That's the number that matters, not the total sitting behind locked vault doors. Imagine renting a storage facility with hundreds of cars inside. It may look like there's an endless supply, but if almost all of those vehicles already belong to private owners, you can't simply walk in and drive one away. The same principle applies here. Eligible silver is privately owned. Just because it's stored in a COMEX-approved vault doesn't mean it's available to satisfy delivery requests. That's why experienced market participants pay far more attention to registered inventories than to the overall total. And once you start comparing that registered supply with the number of outstanding futures contracts, the picture becomes much more interesting. Every COMEX silver futures contract represents 5,000 ounces. Open interest simply refers to the total number of contracts that are still active and haven't been closed or settled. When you multiply those contracts by 5,000 ounces each, the paper market represents an enormous amount of silver. Recent figures have shown open interest equivalent to well over 250 million ounces, with some reporting periods pushing beyond 275 million ounces. Now compare that with the registered inventory that's currently available for delivery. The gap becomes impossible to ignore. Coverage ratios have dropped into roughly the low 30% range, sometimes even lower depending on the reporting date. In practical terms, that means every ounce of registered silver is supporting roughly 3 ounces of paper claims. Now let's keep this in proper perspective. This doesn't automatically mean COMEX is about to fail or run out of silver. Futures markets have always operated this way. Most traders never intend to take physical delivery. They're simply trading price movements. As contracts approach expiration, the majority are rolled forward or closed out long before any metal changes hands. That system has functioned successfully for decades. However, one important trend has started attracting attention. More participants are choosing physical delivery instead of simply closing their positions. Delivery activity on COMEX has remained elevated, with an increasing number of buyers effectively saying, "I don't want another paper contract, I want the actual silver." That's where shrinking registered inventories begin to matter. If more investors request physical delivery, while the amount of registered silver continues declining, available supply becomes tighter. Every delivery removes more pressure from an already reduced pool of deliverable metal, leaving the system with a smaller margin for error. To be absolutely clear, we're not looking at a delivery crisis today. The system is still functioning, but what has changed is the cushion. The margin of safety is becoming noticeably smaller than it was only a year ago. And every new warehouse report becomes more important because it tells us whether that trend is continuing or beginning to reverse. There's another question worth asking. Silver doesn't simply disappear. If large amounts are leaving COMEX vaults, where are they actually going? Following that trail reveals another important piece of the puzzle. And once you see where the metal has been moving, the broader global picture starts coming into focus.